You're watching a replay from the 49th Annual Gabelli Automotive Symposium, recorded live via Zoom in Las Vegas. This presentation is shared as originally broadcast. Minor technical interruptions may be present due to the live recording format. Thank you for tuning in.
And diagnostic business focused on alternators and starters and inverters, electric motors, and battery power packs, sort of the electric powertrain fundamentals. So if we want to do Q&A or?
Yeah. So we can start with the business and some of the operations you guys do. So can you just review for us your breakdown of customers kind of between the warehouse distributors, large distributors like AutoZone, O'Reilly, and then any direct selling if you do any?
Yeah. So the vast majority of we sell almost everybody in the marketplace. All the retailers, big chunk of the WDs. We don't segment report, or we don't report by customers, but we probably 60% of our revenues to the professional installer and about 40% to the DIY market.
And then, so we've talked about kind of the complexity of getting, hundreds of thousands SKUs to the end customer within, short time, 30 minutes. Can you just talk to us about how you help some of these big distributors kind of serve their customers in that sense?
So it goes back to, thank God we don't have to distribute within 30 minutes. So, but it goes back to sort of our branding strategy. Probably 25 years ago, we decided to become a B2B brand and really focus on doing all the things for the retailer that a consumer product company would do for themselves. And so we have incredible vendor managed inventory capabilities, category management capabilities, and we track all the statistics on registrations on the vehicles. We know where they are. We know whether it's likely to be a DIY job or a DIFM job. And so we're able to help our customers be more effective than our competitors' customers and have the inventory in the right place. And there's 220 plus thousand varieties of light and medium vehicles on the road. So you can't carry all of that and deliver within 30 minutes, but using the hub and spoke systems that these retailers have and the WDs have, that we're able to get the right product in the right locations. And that helps them.
Can you just give us a quick overview on your remanufacturing process and kind of what the value add is there, and what kind of customer would prefer that over
Well, the first thing to understand is, why do we exist? It's really the fundamentals is that when an OE manufacturer plans their vehicle production and they're not making the parts necessarily that we make, they plan enough for their production for that year and perhaps maybe for warranty replacement that year. Most of the time, they don't even get through the warranty replacement. And then you move on, and then 5 years later, that vehicle fails, and that OE is not making those. The OE manufacturer is not making those parts anymore. So the only way you can really get them remade, which is basically remanufacturing is almost a diminished title for what it is, because they completely remade, but they remade with the original equipment. And that's the only real way. So you talk about, if you really want a replacement that's as identical to OE as you can get them, remanufacturing is the answer. And so most cars have a one-time replacement. As the vehicles get better, you get more than one. So most of the replacements that are coming in are from original equipment cores. The broken down units are original equipment. And so you're able to reproduce an original OE style product as opposed to a knockoff type product, which is a new unit, which everyone thinks new. Oh, it's new, maybe better. But the reality is it's probably not.
Gotcha. And then just talk about how you're positioning the company for increased complexity, EVs, autonomous vehicles, and if this is a benefit to Motorcar Parts of America.
Yeah, so one of the things first of all, we think we have plenty of time for the EV space, and I think that's sort of being proven out. You've got, I think, 293 million cars on the road, and the vast majority of them are not EV. They're either hybrid. Most of them are just straight combustion engine, a little bit of hybrid out there. But the beauty of the aftermarket is it's not a market you need to look forward. You've got to look backwards. And so while we have significant know-how on how to, because we develop all the diagnostics on inverters and battery packs, and we don't have to worry about that for a lot of years. Okay, we look back when they start failing and there's any density in the market as a remanufacturer with core competency or a manufacturer, we'll make what's needed. You know, we have some ideas of what's coming, but you know, I think my kids will be in better position to worry about that than me. So
Perfect. And then, yeah, we'll move on to kind of just the environment, kind of more recently, some of the dynamics going on. So can you just talk about your exposure to tariffs and what kind of steps you're taking to diversify manufacturing and sourcing footprint?
yeah, so you know, I've never, 10, 15 years ago, I really took the initiative to try and remove as much as we could out of China, and not because I anticipated tariffs. I mean, I'd be clairvoyant on that one, but I just felt that the social environment there was not conducive to stability, and so I decided that we would take most of our production and reliance on away from China, and we did that. And so we're pretty much based in Mexico and Malaysia. I mean, Malaysia does have tariff. We are exempt of the USMCA in our Mexican operation. But we've got, we're a lean manufacturer, and our efficiencies enable us to put more into Mexico, and there's lots of capacity to absorb. So we're flexible in terms of where we can move production. So right now we're very comfortable with that footprint. I mean, we do have some Chinese reliance and we do have tariffs, but we think we can be a leader in sort of mitigating that. Obviously, automotive tariffs are everywhere other than Canada and Mexico right now in the USMCA compliant product, and we'll see how that all goes. But we think we can leverage that effectively, very effectively.
And then given kind of some of the pressures the consumer's been facing on inflation, how comfortable are you on your ability to pass through any price if needed to offset some of the cost increases?
The reality is there are cost increases and someone's got to pay for them. And so we're passing them through, and sometimes not as successfully as you want to be, but we are passing through price increases. I mean, there is no choice. And at the end of the day, we're non-discretionary parts, and we make a great product, and we're the trustworthy, reliable, financially secure. We've got less than about a half a turn of debt on EBITDA, and we have capacity, and we're legitimate, and we're there every day, and we will need to be paid fair value for our products, and that's really our opinion, you know. And so less worried about revenue growth than I am about making sure that we get the right returns on what we do every day and generate cash. And I mean, we're on our way to being completely debt free and buying back stock and being able to deploy it in whatever the opportunities come up. So, you know, we're excited about that. I think we're in a great position.
And then given some of the more recent news around factoring the supply chain financing programs, can you just talk about Motorcar Parts' use of these factoring programs and how it affects working capital and you know, reported cash flows?
I mean, the retailers all got their supply chain financing programs. That's pretty much what we do. Everything we do is on the balance sheet. Everything we do is pretty easily reported. I mean, we have interest expense that reflects around that. You know, nothing's really changed for us. I mean, I think we have a very simple method, and it's not our financing, it's our customers' financing.
So you don't expect any changes to come about the recent First Brands bankruptcy?
Yeah, I don't expect the retailers to have to change their programs, and I'm not hearing any bounce back from the banks. I mean, the banks have called us and asked questions. It's not our programs, but I don't anticipate those changing.
And then how is kind of recent interest rate cuts been a benefit towards these programs and the interest rate expense?
Yeah, well, it's been a good and a bad for us. I mean, the good is the rates are coming down. We like that. The bad is we never got the benefit of price increases when they went up. So we're just running on the spot really on interest rates. But eventually, every point in interest is a reduction in factoring in the supply chain factoring cost of about 7 million a year. So our profitability will come back because we never got the price increases. We have nothing to give back.
Okay, so moving along towards kind of just the different product lines you guys have and how you've kind of expanded and entered into new lines recently. Can you just talk about the expansion, how it kind of fits with the old line?
Yeah, so we, at one point we had, and we still do, over 50% of the rotating electrical business in the United States. So we, the big challenge was, do we take that and become an international rotating electrical company, or do we leverage our relationships with the supply chain? And we decided to leverage our relationships with the supply chain and choose parts that had big market value and that were somewhat technology agnostic. So we made a big push into the brake business, and we're a full line brake supplier today. I mean, we do, that brake category is a couple $100 million for us, and it's probably only about 5 years old. So we're excited about where we are there, and we think there's going to be a lot more opportunity for us in that space.
Yeah, so that brake caliper business started as kind of greenfield operation about, you said, 5-6 years ago. So can you just discuss the growth there and kind of the margin opportunity moving forward?
I mean, the growth has been phenomenal. I mean, I don't know whether we're the second largest player now or not. I'm not sure, but obviously, we make a great product. We ship it reliably. It's a state-of-the-art facility. And as we scale the absorption of the overhead in that facility, we're seeing margin accretion. We'll see that continue. And so I think that there's some weakness in the market around us in terms of our competitor base. And so we're aggressive, and not so much we're aggressive in making sure that we have the best product and that it's available to people who need it. I mean, we're not price aggressive, but we're aggressive in being proud of the need that we're filling. And we think there's a big opportunity going forward there. And in other brake products. I mean, we've got a family of brake product lines that are going to grow, and they will produce margin. And so we're excited about that.
So when you choose to enter a space like on this brake caliper side, from whom are you typically taking share when you're successful?
Well, it depends on the category you go, right? I mean, there was when we entered into the brake caliper business, there was a significant supply chain challenge. I mean, the fill rates in the industry were very, very low. And we had a lot of customers coming to us. I mean, a lot of our growth has been initiated by customers. In fact, I saw one of what I call is the co-founder, a former retailer, who invited me to go to see them. He said, "Can you be here tomorrow?" I said, "I can't be there tomorrow. I got to go to a conference in New York." He said, "I'll meet you in New York tomorrow." And that night, without having produced one brake caliper, we ended up with a commitment of close to $100 million of brake caliper business. And we'd never been in the business. Okay, people trust us, and we're there sometimes for better or sometimes for worse, but we're there, and we live by our word, and we are reliable, and we've built, I think, the state-of-the-art brake caliper program.
Brian, did you have one? Oh, well, we've
going. Okay. A couple of questions, actually. So this came up in one of the earlier meetings. And I know it's difficult to answer. I just want to see how you're thinking about it. But the potential renegotiation of the trade pact with the United States and Mexico. You've obviously put a lot of focus on Mexico. You've moved a lot of your manufacturing there. I mean, how are you thinking about that as a potential variable for motor car parts?
I don't know how to think about any of this stuff. So if I told you I was thinking about it, I'd be lying. But you know, we have flexibility. I mean, we do have some flexibility. I think from a relative competitive base, you know, we will certainly be no worse off than any of our competitors with the footprint that we have. We do have significant capability in in Malaysia as well. I mean, we're ramping up there. We've opened up new facilities there. We've got one of the biggest assets we have is experienced workforce on the production floor. And gives you a tremendous flexibility to be able to move around into different parts. But, you know, with the tariffs keep changing and you can't just jump around from place to place. So at some point, someone's going to have to pay for that. And at some point it settles down. You know, I was sort of hoping that we were there now. We'll have to see. You know, I'm also bullish that being close to the borders, all in all, is still going to be more effective than running all over the world to try and avoid a tariff, you know, whether it be even made in the USA for that matter. So, but I don't know the answer, Brian. I mean, I just don't. I mean, I read it just like everybody else and wonder what's next, you know, so, yeah.
Second question, if I could, again, this also maybe not a total fair question, so I know you're reporting next week, but we've heard from, you know, you talk all the time about your business that you're in the, you know, the non-discretionary side of auto parts. And so we've heard from retailers lately, I think O'Reilly and then to a certain extent Advanced Auto Parts talked about this, but you know, they might be seeing some type of impacts on demand, you know, even with in categories that may have been less discretionary because of tariffs and pricing and consumer. Is that something you're seeing in your business, or, you know, could plan upon that at all?
Look, I mean, you can't drive if your car doesn't start, and you can't drive if your car doesn't stop. And we start cars and we stop cars. I mean, that's really what it is. You can defer your brake job a little bit, but at some point, and that's not a real big deferral, that ends. You've got to. Our parts are all pretty much not pretty much. They all are non-discretionary. I think the challenge is where's the consumer going to buy it? You know, I mean, the consumer's going to decide where he can get the most efficient deal for them. And, you know, as different alternative channels become more efficient, they got more choices. And so, but for us, you know, the producer's producing. And so, yeah, there may be some consumers that will try and go to a more, to a cheaper solution, but at the end of the day, the consumer needs faith that their product's going to work, and we're giving lifetime warranties on products that are wear items, which is, you know, a little bit crazy. But the point is, it does give the consumer confidence that you're buying a legitimate product. And so, yeah, I do see, you know, some of that, but, you know, I think for our products generally, and I've seen this in recessionary times, we hold our own. So I expect that to happen. I'm more worried about, you know, what the channels will do for the non-discretionary items, how that affects where their capital goes and what happens, you know. I mean, but I think the non-discretion will be there for them. Just hope that, you know, that there's not diversion because of the discretionary items.
Selwyn, just a quick question on the.
Where's this coming from? Oh, there.
Hey, Selwyn, I guess you've got brake rotors and pads up there on your slide, and obviously Centric and Robestis at First Brands are in those categories. Do you see any near-term share gain opportunities, or the retailers shopping for alternative suppliers as we speak?
Look, I think we've got a lot of opportunity. We've got a lot of capacity. We're trusted, and we have, to be honest with you, we have fantastic brake products. And I mean, every company says that, but the original Centric formulations are ours. So they're no longer Centrics. And I think that we're a natural, so but we'll have to wait and see where that all goes. But there's definitely a lot of opportunity, I believe.
So you stated that your diagnostic business could be $100 million+ business in the future. Can you just talk about where you're at now and the kind of investments needed to get it to that level?
You know, we have, we call it our diagnostics business. It sounds like it's really amazing, but our diagnostics business is focused along this little red machine here that, I don't know if the slide's still on behind me. Yeah. That little red machine is will be in every single retail store, perhaps in the world. It's the only machine that can test the communication protocols for alternators and starters. And if you can't test that, you'll have fake results, because when you put your it's like the inkjet cartridges. If you've got a alternator that doesn't have the right communication protocol, control module in the vehicle is going to shut down the vehicle because it's going to be a knockoff. Okay, so if you don't test using that, you're never going to know whether you've got a unit that really works or not. So it's on its way to being in every store in the United States, and I think we're moving into other countries now, and that alone is $100 million business and ongoing. And then we've got all the other stuff, okay? I mean, which is also around rotating electrical. Every OE manufacturer uses our diagnostics really to make their product. And I would imagine, and I believe almost all our competitors use our diagnostic equipment to make their product. So, I mean, we are the standard for rotating electrical quality. And then on the periphery of that, we've got, electric powertrain applications. And to be honest with you, that to me is a little bit on the side of our mainstream. It's not where we don't wake up every day and think about electric vehicles. We wake up every day and thinking about a non-discretionary aftermarket hard parts. In the electric vehicle, we have plenty of time for that. And I hope I don't eat my words, but you can see it coming, so we'll be there when the time is right.
And then Mexico is also highlighted as kind of growth opportunity moving forward. Can you talk about the vehicle population there and where you see the biggest opportunities?
Look, I mean, in Mexico, the most significant thing for the Mexican marketplace is that discretionary income has gone up. Minimum wages have gone up there dramatically. I mean, the government implements these 20% increases, 12% increases. And while that's not so great for us as a manufacturer, it's phenomenal for us as a supplier, because people don't have to tear their cars apart themselves. They can go somewhere and get it repaired. They can buy another finished good unit. And if you look at the results of some of the retailers that's all public out there, they're experiencing, significant growth there, and so are we. And we're there. On top of it, we are very Hispanic friendly. I mean, as an entity. So, I mean, our base is really Hispanic.
Just touching on profitability, if we look at gross margins kind of pre-COVID, they were 20+%. How has the operating environment changed since then, and do you see a path back towards that number?
Well, I'll just start with we're there. I mean, we are sort of low 20s now, back at that. We've been through a massive amount of inflation, and pricing has been difficult to get price increases, but we've worked through that. We've worked through eliminating waste and efficiency, and I think we have the most efficient manufacturing facilities in the world. I mean, in what we do, and we've had a number of OE customers tell us that. So I think margin pressure is always in the aftermarket, is always a reality, but our fundamentals are getting stronger and stronger, especially if we get opportunity from the current changes in the marketplace, and we continue to grow our business. Overhead absorption will become a big contributor to margin. So we're cautiously optimistic about that.
And then just on capital allocation, can you just talk about how you're prioritizing organic investment, debt reduction, share repurchase?
Look, to the extent that we feel that we're undervalued, and to the extent that we feel like we have lots of liquidity, which we feel both, we buy back shares, and we've been doing that. And we're very cautious about it because we don't want to jeopardize any liquidity issues. But I can tell you, our liquidity hasn't been this strong, I don't know, probably in the last 20 years. I mean, the company is doing very well from a cash perspective, and we think that our stock is an opportunity. I think our average purchase prices are that we reported were around, I don't know, Harold, do you remember that number? About 11 $11 is somewhere around there. The stock, hit 18 today, so 9.19. Okay, so there you go. We even got it cheaper than I thought. So, so we've done well buying back stock, and we think we have continued opportunity to do that.
And any potential M&A you see in the future?
That's all opportunistic. We'll have to see. I mean, our focus, we have tons of organic opportunity, especially in light of where the marketplace goes and the capacity and the capability that we have. So if there's opportunity, we'll certainly look at that. But really, we focused on organic growth and really managed organic growth. I mean, trying to make sure that that we're no longer proving a point on share, we're proving a point on being viable. And you've seen that in our numbers we've generated. If you look at the summary, the trailing 12-month adjusted EBITDA is almost $100 million. Cash is $76 million. And net debt is down dramatically. And the share count has come down, and our volume in our trading has gone up. And so I think we've eliminated some less profitable opportunities, and so we're holding on. Yeah.
Well, I really appreciate you being here, and thank you for speaking. Looking forward to seeing
Great. Well, thank
where
you.
it goes in the future.
Thank you so much again for including us. It's always a pleasure to be here, and appreciate everybody's time.
Brian Sponheimer is a portfolio manager and Edward Nakamura is a research analyst at Gabelli Funds. This webcast is a recording from the 49th Annual Automotive Symposium, which occurred on November 3rd and November 4th, 2025, in Las Vegas, Nevada. GAMCO is providing these links as a matter of general information. We do not intend for these links to be a complete description of any security or company, nor is it a research report with respect to any of the companies mentioned herein. As of September 30th, 2025, affiliates of GAMCO Investors Incorporated beneficially own 24.44% of Stratec, 10.09% of Rush Enterprises Class B and less than 1% of Class A, 6.44% of Standard Motor Products, 4.39% of Monroe, 3.96% of Dana, 1.68% of AutoNation, 1.17% of Advance Auto Parts and less than 1% of all companies mentioned. The analyst's views are subject to change at any time based on market and other conditions. The information in this posting represents the opinions of the analyst and is not intended to be a forecast of future events, a guarantee of future results, or investment advice. Views expressed are those of the analyst and may differ from those of other GAMCO officers, analysts, other employees, or of the firm as a whole. Because the investment personnel at GAMCO and our affiliates make individual investment decisions with respect to the client accounts that they manage, these accounts may have transactions inconsistent with the information contained in this posting. Certain GAMCO personnel may know the substance of the posting prior to its posting. This webcast is not an offer to sell any security, nor is it a solicitation of an offer to buy any security. Stocks are subject to market, economic and business risks that cause their prices to fluctuate. When you sell shares, they may be worth less than what you paid for them. For more information, a prospectus, or summary prospectus, visit our website at www.gabelli.com or call 800-GABELLI 800-422-3554 914-921-5100 fax 914-921-5118 info@gabelli.com.